Marc Ostwald from ADM Investor Services International, with some thoughts this week on the oil sector. Obviously, had a bit of a torrid time of late, and my first chart is of the WTI oil price. As one can see, we've certainly recovered quite sharply from the debacle that we had in March and April. But significantly, when one looks at that particular chart, it highlights that we've basically gone up, filled the gap that was there, and then tailed off, largely in response to expectations for the global economy and therefore global oil demand. And it's proving to be a very good indicator of what sentiment is like on the global economy. So my next chart is about how the oil sector is doing. This is the North American energy sector bankruptcies. As one can see, both in exploration and production and in oil field services, we are starting to see a fairly rapid rise in the number of Chapter 11 filings, or i.e. filings for bankruptcy protection from creditors, which is really altogether not surprising when one considers what we had in the quarterly Dallas Fed Energy Survey of Q3, which was published on the 23rd of September, from which my next two tables stroke charts come. The first one is expectations for oil prices. As one can see, this is for the end of 2020. As one can see, the consensus seems to be something in the $40 to $45 area, slightly above where we are at the moment. There is some optimism that it might actually go higher than that. But when one looks at the next table, which is rig count expectations versus price, what one can see is basically rig count expectations for a substantial increase, as the Dallas Fed calls it, suggests that the oil price is not, according to the survey, going to get to the sort of levels where they would expect a meaningful increase in the rig count. So that, in turn, suggests that production is not likely to expand that rapidly and would require a much stronger boost to oil prices. So for my final chart, and this is probably the interesting one, I've got the credit spreads, and this is for the high yield energy sector, and comparing it with the all sector high yield. As one can see, obviously the spreads are notably higher in the energy sector, but they have recovered largely to their pre-crisis levels. That would seem to be in contrast to the message that we're getting from the oil price on the one hand, and indeed the message from in terms of bankruptcies. And there's a good reason for this, namely that basically this is showing a considerable improvement, but it's showing considerable improvement because of a survivor bias. So gradually, as more companies fall out of the index because they're going bankrupt, so the spreads start to tighten and the quality of the credit actually starts to improve. So general message here is that despite the good performance of the high yield energy credit sector, that actually gives the lie to the fact that all is not well there. And if one looks at the Dallas Fed survey, it's notable that while it bounced very sharply from Q3, expectations for any metric that one cares to think of, production, business activity, capex, employment, all still in negative territory. So a few thoughts there for the oil market this week.